What if I told you that while everyone's panicking about one AI stock, the numbers are screaming the exact opposite? Welcome back to Smart Stock Sam, where we cut through the noise and follow the data. Today, we're diving deep into super microcomputer before earnings. And trust me, you'll want to hear this before making any moves on whether to buy or wait. Right now, one of the most critical players in the AI revolution is seeing its revenue absolutely explode while its stock price gets crushed. This is what I call the Blitzscaling Paradox. While the market punishes super microcomputer for short-term margin compression, the data reveals a strategic land grab for AI dominance that most investors are completely missing. We're not just looking at a niche player here. We're watching a transition into an infrastructure hegemon. But here's the question. Is the market wrong, or are we missing something massive? Before we understand why hardware is so misunderstood, we need to look at what's happening to the software giants. There's a massive rotation happening right now. Investors are fleeing traditional SaaS companies like Salesforce and Workday because they're terrified that AI agents will replace human seats and kill their business models. But here's what the data actually shows. When you normalize for growth, these so-called expensive software stocks and cheap ones often trade at parity. We need to apply this exact same growth-adjusted logic to AI hardware if we want to find the real value hiding in plain sight. When you dig into the actual numbers, the conflict becomes impossible to ignore. SMCI's market share has rocketed from a tiny 3.5% in 2021 to a massive 27% today. Revenue is projected to hit a staggering $44 billion by 2026. That's not a typo. However, gross margins have dipped to 10%. The market sees flat earnings per share as a failure, but for a growth-adjusted thesis, this isn't a bug. It's the strategic cost of total market acquisition. So the real question is, what if these compressed margins aren't weakness, but warfare? There's a hidden mechanism behind this expansion that explains exactly why the margins are dropping, and it's actually brilliant. This is blitzscaling in its purest form. SMCI is using its differentiated engineering, specifically its liquid cooling technology, to deploy faster than anyone else in the industry. They're intentionally starting a price war to lock out giants like Dell and HPE, and they're funding it with a massive $710 million revolving credit line used as liquidity fuel. Remember this, margins are the temporary casualty of a permanent market share victory. But can they actually pull this off, or will the giants crush them? So, what is all this growth actually worth compared to the rest of the field? This is where things get wild. Investors are currently paying nearly 7 times less for SMCI's growth than they are for Dell's growth. Think about that for a second. You're essentially paying roughly 47 cents for every dollar of sales in a company growing at a breakneck 65%. This is the lowest valuation we've seen since the delisting fears of 2020. The question you have to ask yourself is this a value trap or the opportunity of the decade? None of this matters if the company is just sitting on a mountain of unsold inventory, right? Well, that's exactly where the narrative completely shifts. The chart looks broken with a technical ceiling at $30.63, but look at the inventory reality. Those high inventory levels aren't unsold goods collecting dust. They're pre-ordered liquid-cooled racks waiting for a final $10.4 billion Q4 burst. SMCI has a credibility gap because they've missed expectations 6 times recently, and the market is demanding a verified beat to fix these technical issues. But what if this next earnings call changes everything? So what are the specific make-or-break moments we need to watch for in the upcoming earnings? We're looking at 3 distinct paths. Scenario A is the re-rate. If they beat revenue and affirm that $44 billion guidance for 2026, the target quickly shifts to the $35 to $41 range. Scenario B is consolidation, where we chop sideways between $28 and $32. Scenario C is the trap. If revenue misses and margins compress further, we could see a breakdown into the low 20s. That's the nightmare scenario. Frustrating, but manageable. Which scenario do you think is most likely? This brings us to the ultimate verdict on this stock, and the math here is crystal clear. SMCI is a coiled spring. While the current price sits around $28, the conservative fair value based on a 0.75 times price-to-sales multiple is $55. That's nearly double from here. If we see a mean reversion to normal tech multiples, the Super Bull case puts this in a range of $130 to over $200. Now, I know that sounds insane, but the death of hardware margins is a myth. It's a temporary cost for a permanent AI moat. Remember, men lie, women lie, but numbers do not lie. This is not financial advice. I'm not a financial advisor. This analysis is for educational and entertainment purposes only. Always do your own research and consult with a qualified financial professional before making any investment decisions. Past performance does not guarantee future results. So what's your take? Are you buying before earnings or waiting for confirmation? Drop your thoughts in the comments below, smash that like button if you found this valuable, and subscribe to Smart Stock Sam for more data-driven analysis that cuts through the market noise. See you in the next one.